So today's video is going to be all about new changes that are happening in regards to the tax world, to the IRS, and I'll be going over a lot of new information so I can keep you guys educated. I like to make my videos specifically for individuals and small business owners, but I'm open to learning and teaching a little bit more outside of my scope. Now, most people will think about the IRS maybe once a year right before filing season, and they'll do everything they can to forget about it. But by you watching this video, I am fully aware that you're not one of those people. You want to stay informed, you want to stay educated, and you want to understand the changes that are coming for the 2026 tax year that might affect your tax liability or your tax refund. Now, these rules will affect both individuals and small business owners, and knowing them can help you plan ahead and make smarter decisions. I'll go ahead and let y'all know that this video is educational only. It's for educational purposes only, and nothing that I say is tax advice or financial advice. Everything that I shared today comes directly from the information that the IRS has already released to the public, and most Americans will not hear about these things until it's too late to act on them. So I want to educate you as best as possible and have you come out of this video knowing a lot of new information for the year of 2026. I'll walk you through the 2026 tax rules and the opportunities that will affect individuals and small businesses starting January 1st, 2026. Now, my name is Daphne. I am a tax preparer. I do handle tax preparation and bookkeeping. I handle quarterly filings for individuals and small businesses, and this is mostly in the southeast part of the United States. So this includes states like Tennessee, Mississippi, Louisiana, Arkansas, Kentucky, Alabama, Georgia, North and South Carolina, and Florida. So if you're interested, I will leave those in the description down below. All right, so the first thing that we're going to go over is the overview of what has changed. So the IRS has officially released its annual inflation adjustments for the tax year of 2026, along with updates of the One Big Beautiful Bill. It's also called the OBBB. This affects more than 60 different tax provisions, everything from your standard deduction to tax brackets to your credits and estate tax exemptions. I will not go too much into detail about state tax exemptions, but a little bit, since they do go outside of the individual and small business general area. So those adjustments will apply to tax returns that you file in 2027 based off income earned in 2026. This is why I'm educating you about it now before you step into 2026. So even though this sounds like future, the smart move is to just plan now and take this information in now and apply it for the year of 2026 starting 2027. So let's start with the standard deduction because this affects most taxpayers. Now, the standard deduction is a fixed rate amount. This is the part of your income that you do not pay taxes on is your standard deduction. The IRS provides you a standard fixed amount, and this is the amount of income that is automatically tax-free. It's what you subtract from your total income before your tax rate is applied. For 2026, under the One Big Beautiful Bill, the standard deduction will be $32,200 for married couples that are filing jointly, $16,100 for single filers or those that are married but want to file separately, and $24,150 for head of households. Now, these numbers are slightly higher than 2025. This is why I'm bringing it up because there are new changes and these adjustments have changed due to inflation. So every year the standard deduction normally changes, and this year this is the new standard deduction amounts. What this means for you, if you do not itemize deductions like your mortgage interest or charitable gifting, you're automatically going to take the standard deduction and you'll get to deduct this amount on your taxable income. Going into itemized deductions, that's a little bit different. Usually itemizing means keeping track of your records like your mortgage interest, how much charitable giving you gave throughout the year, and it's not a fixed amount, but it's based on medical expenses and tracking everything throughout the year. That is a route you can take, but just based off of 2026, the standard deduction does involve these new numbers. All right, so the next thing that I'll be talking about is about tax brackets and rates. or you can also call them income layers. Each layer of your income is taxed at different rates. They're not all taxed at the same rate. So for 2026, the top tax rate remains at 37% for individuals that are making more than $640,600 or $768,700 for married couples that are filing jointly. Now there are other rates like 35% for incomes over 256,225, 32% for incomes over 201,775, 24% for incomes over 105,700, and 22% for incomes over 50,400. Then there is of course the 12% for incomes over 12,400, and the lowest rate, which is 10%, which applies for income below 12,400. Now, the important thing to understand is that only the portion of your income that is in that range is taxed at that rate. So, for example, if you make $60,000, not all of it is going to be taxed at 22%. Only the part above 50,400 is. So knowing your bracket does help you plan better. For example, by timing your income or deductions, this helps you stay in a lower tax bracket, paying less. Planning ahead, contributing to, certain deductions and things like that can lower your overall bracket. Now, the next thing that we'll mention is the alternative minimum tax and estate tax. I will go in and dabble a little bit into this, but like I said, I like to stay within my expertise, which is individuals and small businesses. Next is the alternative minimum tax. Some people like to call it the AMT. This is a separate calculation that is designed to make sure that high income earners pay at least a minimum amount of tax, even if they claim loss of deductions or credits. So this is an additional tax that higher income earners receive. For 2026, the AMT exception is $90,100. This is for single filers and $140,200 for married couples that are filing jointly. Now, these exceptions start to phase out at $500,000 for singles and $1 million for couples. Now, the thing to mention is it's an exception. So exceptions, the $90,100 for single filers and the $140,200 for married couples filing jointly has increased. So it used to be at a lower amount, but they've now increased it, which means that higher income earners will not be taxed until they reach this income requirement, and the income requirement was increased. Now, for those that are thinking about estate planning, the estate tax threshold is going up again. If someone passes away in 2026, the estate is exempt for tax up to $15 million. That's up because it used to be in 2026 $13.99 million. This means fewer estates will owe estate tax, but if you're close to the threshold, this is an area to plan ahead carefully with professional advice. All right, so the next thing we'll be going over is adoption and child credits. Now, this one I like to talk about because this influences and impacts a lot of different families and a lot of different people. And then the next thing I'll be going over is earned income credit and everyday benefits. So this influences a lot of everyday Americans. Okay, so in regards to adoption and child care credits, families and business owners get some good news here. The adoption tax credit has increased slightly. For 2026, the maximum credit is $17,670 per child. So this has increased from 2025 up to 2026, and up to $5,120 that can now be refundable from that portion of adoption tax credit. This means that you could still receive that money even if you owe no taxes. For business owners, the employer provided child tax credit has a major boost as well. In 2026, it increases from $150,000 to $500,000. So this is a big major change, or it can also be $600,000 for eligible small businesses. This is a significant incentive for employers to offer childcare benefits and for employees. It can be more impactful in the workplace because parents do have kids, and in this situation, a lot of business owners do benefit from this credit. offering child care benefits for employees. As I've mentioned, the adoption tax credit has increased slightly. This is good news because now the refund is there, and there is also the adoption credit that has increased, which allows a lot more people to benefit from the credit if you do adopt. Next thing we'll be mentioning is the earned income tax credit. So the earned income tax credit is a very common credit that a lot of, usually individuals that are within the low to moderate income workers benefit from if they have children. For 2026, the maximum earned income tax credit is $8,231 for families that have 3 or more qualifying children. It's up slightly from 2025, which was the previous year, which is good. And other everyday benefits involve the qualified transportation benefits, things like parking or computer passes. That goes up to $3,400 per month. The health flexible spending account contribution limit increases now to $3,400, and the carryover limit, what you can roll over if you don't use it at all, is now $680. Now, you may see these small changes, but together they make a big noticeable difference in your overall day tax picture. As of right now, it's looking pretty good for low to moderate income workers because they're now benefiting from this earned income tax credit. All right, so the next thing is the medical savings, foreign income, and gifts section. So medical savings accounts, they're also called MSAs, which are similar to HSAs, which are health savings accounts, but they're for certain high deductible plans. For 2026, if you have self-only coverage, your deductible must be between $2,900 and $4,400, and your out-of-pocket maximum is $5,850. For family coverage, the deductible is $5,850 to $8,750, and the out-of-pocket cap is $10,700. If you work abroad, the foreign earned income exclusion, this is the amount of income that you can exclude from the U.S. taxes. This increases to $132,900 in 2026. And for those doing estate or gift planning, the annual gift tax exclusion stays at $19,000 per recipient. But for gifts to a non-U.S. citizen spouse, the exclusion increases to $194,000. Next thing we'll mention is the items that are not affected by inflation. Now let's talk about what didn't change. Certain items are not adjusted for inflation because, Congress made them permanent in the previous bills. For example, the personal exception remains at zero, just as it has since the 2027 Tax Cuts and Job Acts. The itemized deduction limit that used to restrict how much you could deduct was eliminated, and the One Big Beautiful Bill made it permanent, though it does limit the benefit of taxpayers in the top 37%. Another thing that has remained unchanged is the lifetime learning credit. This means that your eligibility starts to phase out when your modified adjusted gross income reaches $80,000 for single filers or $160,000 for joint filers. Now, what this means to you, this is very important. So this means 2026 will now bring higher deductions, slightly expanded credits, and inflation adjusted thresholds across the board. If you are self-employed or own a small business, this could affect how you set salaries, benefits, and overall business structures. If you're an individual, it can change which deductions or credits benefit you the most, or how much withholding you'll want from your paycheck. This is also a great time to review your 2025 return and identify what adjustments you can make before the year end this year 2025. The IRS is raising more limits slightly according to inflation. The One Big Beautiful Bill locks in several taxpayer-friendly changes permanently, but these updates only help if you understand them early and you plan ahead. I've tried to inform you as best as I can, so whether you manage your personal finances or run a small business, using this information will make you be able to use more strategic moves before January 1st, 2026. Because once this tax year starts, your flexibility goes down fast. Again, I am Daphne, and remember, this video is educational only, no tax advice, no financial advice, and I do help individuals and small businesses throughout the southeast part of the US. So if you're interested in bookkeeping, tax preparation, and quarterly filings for me to be able to help you throughout this tax year. I would love to be able to do that for you. And if you found this video helpful, make sure to subscribe and share it with someone who could benefit from this video. It's as clear as I could say it. If you have any questions, leave them down below so I could answer them for you as best as possible. Thank you.